8 days ago, the International Energy Agency called it the largest energy supply disruption in modern history. The blockade of the Strait of Hormuz removed 12 million barrels per day from global markets, more than the 1973 and 1979 oil shocks combined, and twice the scale of the Ukraine crisis. Crude settled above $110. The IEA chief said the world was not ready. And on Wednesday, April 15th, the S&P 500 closed at 7,023, a new all-time high. The Nasdaq posted its 10th consecutive day of gains, the longest streak since 2021. Both indexes erased every loss from the war in under 2 weeks, a speed of recovery not seen since 1980. The market is not ignoring the oil shock. It has looked directly at it and decided something else matters more. The surface answer is Iran peace hopes. Investors are pricing in a deal that hasn't been signed, but that framing misses 3 things happening underneath the headline. First, the earnings season is running ahead of expectations. Johnson & Johnson beat on Q1. BlackRock beat. Citigroup raised its own forecasts. The profit machine is still turning even as oil stays elevated, and that's not what bear cases assumed going into this quarter. Second, the CTA positioning squeeze is amplifying every up move. The S&P 500 hits new all-time highs, reporting from Benzinga and Barron's, both flagged an estimated $45 billion in forced CTA buying, triggered by momentum thresholds, not fundamental conviction, but rules-based flow that shows up regardless of geopolitics. Third, and most important, the energy shock has not yet fully passed through to corporate earnings or consumer spending. The Fed's Beige Book, released Wednesday, said the Iran war is a major source of uncertainty for U.S. businesses, but uncertainty, not collapse. Companies are in wait-and-see mode, not crisis mode. The pain is deferred, not canceled. That deferral is what the market is pricing. It is betting the deal happens before the income statement absorbs the full cost. Microsoft climbed 5.1% on AI data center expansion news out of Norway and Wyoming. Tesla jumped 7.4% on CEO Elon Musk's announcement that the AI-5 chip had reached tape-out, a key production milestone. Alphabet gained over 1% after Bloomberg reported Google's 6.11% stake in SpaceX could deliver a $100 billion windfall at IPO. The market is not rallying despite the crisis. It is rallying on the assets least exposed to $110 oil.
The weight of evidence points toward continued near-term resilience, but only under one condition: the peace timeline holds. The rally's entire internal logic depends on the oil shock being temporary. If negotiations stall past May, if the Strait blockade enters a second month without resolution, the deferred corporate pain begins showing up in Q2 guidance revisions. The Fed's own Beige Book language shifts from uncertainty to contraction. CTA momentum flows reverse just as hard as they accelerated. The recovery scenario is not guaranteed to be symmetric. On the other side, if a ceasefire is announced before May earnings season peaks, the remaining short sellers, still present across energy and industrials, face another squeeze of equal or greater magnitude. The S&P 500 could press towards 7,100 to 7,200 in that scenario, with the Nasdaq leading. The benchmark to watch tomorrow is not oil price itself. It is the tone of Iran-US negotiation headlines before the Thursday open. Any concrete progress or breakdown will move faster than the underlying fundamentals. The market has chosen to trust a deal that doesn't exist yet. The moment that trust cracks, the energy crisis the market has been ignoring becomes the only thing anyone talks about.